Welcome to this lovely Quantopian algorithmic trading meetup. I'm Max Margenot. I'm a data scientist at Quantopian. And I'm here to talk a little bit about statistical arbitrage and some fundamental statistical concepts that go into it, right? So who here does any sort of algorithmic trading at all? Just a little bit. And who here is in tech? Okay, cool. That was bait. I'm sorry. So, algorithmic trading is fun in general, but who's familiar with Quantopian in the first place? We'll give a little spiel about what our deal is, and then I'll get into the actual theoretical cool stuff that we're going to be dealing with. So, Quantopian, leveling Wall Street's playing field. Our whole shtick essentially is democratizing quantitative finance in some way or another. The key assumption there being that quantitative finance needs in some way to be democratized. So what we mostly do is we host a bunch of free open source tools so that people can research and develop algorithmic trading strategies. And what I mean when I say an algorithmic trading strategy is just any sort of instructions that terminates in finite time specifically for the purpose of trading, right? The most basic trading algorithm could just be buy Apple every single day at 10 in the morning, let's say. Now, it's not a particularly complex or interesting algorithm, but it's definitely a trading algorithm. You have some instructions, and you're trading based on them. Cool. What makes things actually interesting and where we actually want to bring a computer into the mix is when we're doing more interesting quantitative analysis or any sort of statistics on these time series in order to determine whether we want to buy or sell. So in this particular case, what I want to talk about is statistical arbitrage. So who here is familiar with the concept of an arbitrage opportunity? Cool. So an arbitrage opportunity is essentially when you can make a couple trades simultaneously to get away with a risk-free profit in some way or another. Essentially, there's an inefficiency in the market for whatever reason, and you trade that inefficiency such that you can make a profit. In this particular case, what I mean by statistical arbitrage is exploiting an inefficiency that we've found due to some sort of statistical analysis, right? So instead of having the world be some way and have there being an inefficiency there that we can take advantage of, the idea is that we have some model, we have some statistical model of how the world is and how the world should be. And we make a trade based on that imbalance. So it's more of a forecasted imbalance than a literal physical imbalance that we can get at. So one of the most basic unit strategies of statistical arbitrage is a pairs trade. And it's based on some fairly fundamental statistical concepts, which are mostly what I'm going to be getting into today. So the stuff I'm going to be working with is out of the Quantopian lecture series, which is my whole deal. I run the Quantopian lecture series, and it's basically a set of free statistics and finance lectures in order to educate people to how they might write a trading algorithm, right? Because as a company, our goal is to allocate to the authors who come up with the best algorithms. So people use this platform, they use their tools, they use these tools to research and research. If they come up with an algorithm that's particularly good, we will license it from them and run that algorithm on institutional capital and give that author a cut of the profit. So that's our whole incentive, right? So we're directly incentivized to make sure that people understand what's going on, because algorithmic trading has a bunch of different moving parts in it. And a lot of people, sometimes they have a finance background, sometimes they have more of a tech background, and there's some sort of gap, because it's very interdisciplinary in order to make it go. And that's where the lecture series comes in. So I'm just going to nip on over to the lectures here, and I'll find, what is it called? Stationarity. Marvelous. So a pairs trade is based on a concept called stationarity. Well, it's based on a concept called cointegration. But in order to build up into cointegration and what that means, first I'm going to talk about the individual components that go into it, namely integration, orders of integration, and stationarity. So this title isn't exactly in the correct order for what is covered in it, but I hope that you will forgive me in that case. So when we deal with a stationary time series, what I mean is I have a time series, some set of points throughout time linked that has the same parameters across time. Every single sample in this time space is drawn from the same exact probability distribution with the same exact parameters. So in the particular case that we're going to be working with, I'm theorizing that all of my stationary time series are going to be normally distributed. And namely, the important part here is that, well, a normal distribution is parameterized by the mean and standard deviation, right? So if I have a stationary set of samples from a normal distribution, then that means there's no trend in the mean, there's no trend in the standard deviation. If I were to sample any segment of time across this overall span of time, the mean would be the same, the standard deviation would be the same. And the reason this is important will, I hope, become clear. So I'm going to define this basic function here, generate data point. I'm just going to generate a sample from a normal distribution. In this particular case, I'm just going to generate some samples with a mean 0, standard deviation 1. Standard normal distribution, nothing special, our favorite distribution. And I'll generate about 100. So this is a stationary time series. Looks like white noise, right? This is the whole point that we're trying to get at. This is what a stationary time series is in general. It's white noise. Now, it doesn't necessarily have to be a normal distribution. It can be whatever distribution, as long as all the samples are from the same distribution with the same exact parameters. And I know that I'm saying it looks stationary and it looks like white noise, but we can never really be certain of a characteristic, especially a statistical characteristic, just by looking at a graph in the first place, right? Graphs are only really good for telling us what something isn't, not for definitively saying this is what something is. So if we were to deal with a non-stationary time series, let's just say that we have a trend in the mean here. We'll just say that the mean depends on time. Then we get something like this. And as we can see, this is a non-stationary time series. We have a trend here. It's a linear trend. It's not that bad, but when we're dealing with financial data, things get significantly worse than this, right? This is a toy example. Even our pathological examples are friendly. So the issue here, even beyond dealing with stationary time series, is just that if we want simple descriptive statistics at all of a non-stationary time series, they're entirely meaningless, right? If I take the mean of this time series overall, this mean is entirely non-descriptive of all of time, except for maybe one instance about it. But if we're at this point in time, the mean that we've observed is probably going to be somewhere down here. So it's a moot point in any case. And stationarity is important partially because of these descriptive statistics, partially because of stuff like this, but also because whenever we're dealing with any sort of time series model or any sort of statistical model, almost always embedded in it is an assumption of stationarity, right? If we're dealing with an autoregressive model, so essentially a linear regression where components depend on previous components in the same time series. If we're dealing with a moving average model, where components depend on a moving average of previous components of the time series. These have an assumption of stationarity baked into them. So a lot of times we're going to be using these models when we're not necessarily sure of the statistical assumptions that go into it, right? And if we make a model without checking the assumptions in the first place, and the model breaks down or it works, we don't really have any reason for knowing one way or the other, right? We violated the assumption in the first place, and we're operating on some relationship or another. There's no reason to believe that it's going to continue to work, or that it even should have worked in the first place. We can't explain any of it. So that's generally why we care, even beyond the context of pairs trading, about stationarity. So how do we actually check for stationarity in the first place, right? I said it's a statistical property. It's not enough to just look at a graph. So obviously, whenever we check for some statistical property, there's a hypothesis test, or any of 10 different hypothesis tests, all to sort of suss out the same idea. What we're going to be working with specifically is the augmented Dickey-Fuller test, which is just one in an illustrious line of stationarity tests. There's also like Phillips-Perrin, ordinary Dickey-Fuller, and probably a couple others that have totally slipped my memory, but we won't worry about them. And as we might be able to expect, our test says that that first time series that we generated deliberately to be stationary is stationary, and that the pathological example is non-stationarity. And that's fine, right? This is the test working exactly as we would expect. But the thing is, whenever we're building models, whenever we're handling data in the real world, you never know what the data generating process is that gives you that. All you can do is sort of step in, take a sample, and go from there. You never know the root process that makes it behave in that particular way in the sample that you're seeing. Which makes sense, right? Because if you knew the exact relationship of what you're looking at, why would you try to estimate a model in the first place? You just use the relationship already. You can skip all this stuff and not deal with it at all. So this is why we need this. This is why we care about this. The issue is you can fool a hypothesis test, right? A hypothesis test is essentially a good guess. You model it as a probability distribution. You see how unlikely the specific event you've seen is. And based on how unlikely it is, you make a judgment after looking at your cutoff value, so your alpha. In this particular case, what I'm looking at is an alpha of 0.01. So fairly stringent. Gives me about a 1% chance of a false positive. But over 1,000 different tests, over 10,000 different tests, I can expect that fully 1% of those are going to be false positives, right? Especially when we have more subtle, sneaky relationships. So what I'm going to do here is I'm going to generate another pathological relationship. So yes?
Sorry, I'm kind of new to this stuff. I'm just asking a couple
Absolutely.
questions. Is the p-value on the display here, is that a typo? Because series A is definitely stationary because it generated it from the stationary set. But here, is that the probability? Is that the probability?
So these are p-values. These, when I talk about p-values, I typically, well, what we're doing here is we're doing a definitive test with a p-value, with a hypothesis test. And when we're doing a definitive test with a hypothesis test, we don't want to think of the degree of the p-value of one way or another. We have a cutoff. In this case, it's 0.01. We only care whether our resulting p-value is less than or greater than that value. And even further than that, right? A hypothesis tells you whether you can reject or fail to reject a null hypothesis. In this particular case, the null hypothesis is that the time series is non-stationary. So in this first case, our p-value is essentially 0. So it's less than 0.01. So we reject the null hypothesis that our time series is non-stationary and conclude that it is a likely stationary time series. If we didn't already know the generating process for it, then that would be about all we get. In this second case, this p-value is greater than 0.01, so we fail to reject the null hypothesis and conclude that it's likely non-stationary. And that's all we're seeing here. So, stuff isn't always as clear-cut as that. Yes?
I have a question about the test. Will it capture if only the higher moments are not stationary? So let's say the mean is stationary, but the standard deviation changes.
Mm-hmm. So the specifics of the augmented Dickey-Fuller test are to look for essentially a unit root in the time series. And if there is a trend in the standard deviation, if there's a trend in any of that sort of thing, it will be in some way expressed in the time series, and it will most likely be caught. I don't remember the specifics of which moments are caught, but definitely the standard deviation, probably skewness and kurtosis. That's more of a sort of I'll go check the specifics of the test later thing and get back to you. But I'm fairly certain you'll get most of it. So what I'm doing here is I'm adding a little periodic trend in the mean here, right? I'm going to say that instead of just t, or instead of just 0 for my data point, I'm going to have the sign of whatever our current time is. So this is going to oscillate between 1 and -1. It's not going to get too far away from anything, right? 1 and -1, not super extreme as far as means go, but definitely not stationary. And here's us using our omniscience to say that, oh, of course, the hypothesis test will pick that up, right, with no issues. It might. I'm never sure whether it's going to pick it up or not. But even just looking at the graph, right, this is a textbook example of why we shouldn't trust graphs when we're looking for statistical properties. This looks almost the same as our white noise from up above. It's totally plausible that this could be a stationary time series if we did not know that by definition it is not. So let's see what our test says. In this case, we're getting that it is likely stationary. And that's just not true. We know that, right? So if we were dealing with this example in the wild, because it's sort of oscillating and it's bounded in some way or another, this wouldn't really be too egregious, right? We're not going to lose too much money if we're making bets based on that time series just because of specifically how it's generated. And it just kind of speaks to the sorts of limitations that we have whenever we're dealing with modeling, whenever we're dealing with tests in the first place, right? There's always this chance that we have a false positive, like in this case, or there's always some chance that we're off. So we make do with the best of what we have, I guess. Now that we have a sort of basic understanding of stationarity, we can build up into kind of the next important concept, building up to cointegration.
Excuse me, in the previous example, not only was it stationary, it wasn't even random, was it?
It was random. It was generated samples from a normal distribution. It's just the mean had a periodic trend in it.
So in the literal sense of the word, it wasn't random. Meaning if we had an algorithm that would detect randomness of those data, would give false.
It was still random. There's just a trend in this particular case. The Hurst exponent would likely tell you that it is still mean reverting. This is just not an instance of stationarity.
Yeah.
So a stationary time series is generally mean reverting, but a mean reverting time series is not always stationary. You can have something that reverts.
But it's definitely not random. Meaning mean reverting, that means the Hurst is not 0.5. It's much less than that.
Yes, but that's still random in some way or another. It's samples from the same distribution. Like this is all samples from the normal distribution. There's just a trend in the mean. It's still random. There's just one component of it is in some way deterministic. But even if the mean at some point in time is 1 or 0.95, or whatever the sign distribution says at that point in time, we're still generating a data point in this particular case. What we'd say then is, okay, well, I want a sample from a normal distribution with a mean of 0.95 and a standard deviation of 1. So I'm still getting a random variable, I just have a trend in it. So this notion of orders of integration, right? Whenever I have a stationary time series, I can represent it as a stationary component, well, a deterministic component, and a random component in its entirety. Namely, I say, hey, yt is my stationary time series. I have this infinite series of random extra information that's incorporated in, and I have this stationary, I have this deterministic part, eta t. And what I mean when I say deterministic is at any point in time t, I know what the value of that function is. Now, we don't have to worry too much about that series not converging, because as part of this representation, we hold that the squared sum of these coefficients here, which are either moving average or autoregressive components, depending on how you define the model. But the squared sum of those is finite, which makes it so that the series ultimately converges. So we're not going to peter off into infinity or negative infinity at any point soon. And the reason we really care about this is this helps to ground kind of the definition of something that's integrated of order 0, which I'm not going to get too technical about, but integration of order 0 is kind of what we care about. And stationarity implies this notion of integration of order 0. While integration of order 0 does not imply stationarity. So since testing for integration of order 0 itself is a little annoying, it's usually more convenient to just check whether something's stationary in the first place, because then you know for sure it's integrated of order 0. And the reason we care about that is because, well, let's just have a look at it, right? So this is our integrated of order 0 time series from up above, the very first time series that we generated. It's stationary, so it's integrated of order 0, no issues. If we want something that's integrated of order 1, all we have to do is cumulatively sum a time series that is integrated of order 0. So kind of like a poor man's integration. This is where the notion of orders of integration comes from, right? Because we're just going to cumulatively sum and cumulatively sum and cumulatively sum as many times as we need. And it has a similar effect to integration as well. where it kind of smooths out the nonsense from before, right? This looks a lot more like a price series. It doesn't look like that white noise all jagged all over the place. It's by no means smooth, but it's smoother than static. Similar, if we cumulatively sum that, we get an integrative order 2 time series, which is significantly smoother. And we can keep doing this n times until we get something that is integrated of order n. And really, we care about something that's integrated of order n because, well, we can break it down to get something that's integrated of order 0 again in the first place, right? Because it's hard to find something that's stationary in the wild. It's hard to find these specific sorts of things without assuming that everything goes along with our assumptions and never actually testing for anything. Because a key assumption in finance is that returns are normally distributed. In other words, that returns are stationary. They all have the same mean, they all have the same standard deviation, and we're not going to worry about it. And this is used in a lot of models that we deal with. But what we want to do is want to make sure that we actually test it and go for it from there. So in order to break down from these orders of integration, there's some notation that we're going to briefly introduce and then not really worry about. But essentially, we're just doing the opposite of a cumulative sum. Instead of a cumulative sum, we're just going to do this first order difference here, which we introduce with the backshift operator L. So if I have some element of a time series, xt, if I apply L to xt, then I get the element xt minus 1. I'm just stepping back in time, just backshift, right? So 1 minus L times xt gives us xt minus 1, which is this delta x. And if we want to break that down d times, then we'll apply the 1 minus L to the backshift, to d to xt. So we'll just do this d times to break down. So if we have some time series that's integrated of order n, we'll just take n first order differences. In practice, what we're probably going to do is take a first order difference, test for stationarity, and go from there. So I briefly said up above that integrated of order 1 time series looks like a price series. And that's kind of the heart of what I'm trying to get at. Whenever we see price series in the wild, theoretically, they are integrated of order 1, because they're essentially a step up from returns, which are stationary and therefore integrated of order 0, right? If we cumulatively sum the returns of some stock or some financial asset, well, then we get its price. If we take every single return the stock has ever had from whatever its starting price is, we'll know what its price is at this point in time.
The log of them, or just returns itself?
Depends on your model, and depends on the type of returns we're talking about. So we can be talking about additive returns or percentage returns.
Do you have additive returns?
You can do both.
Are they stationary?
In the upcoming example, yes.
In real world, so additive returns are random process stationary?
Depends on the random process. There are some random processes that are not stationary, right? Because a geometric Brownian motion or...
Yeah, that's what I'm saying. So in reality, in real world prices, do we have additive? Can we model them with additive random?
I mean, yes. Just because, well, if you observe stuff in the wild, you can just take the difference of today's price and yesterday's price, and you could add that to yesterday's price, and you'd get today's price.
It seems like they are getting bigger and bigger.
In which case, then those returns wouldn't be stationary.
Yeah.
Yeah. But if those additive returns are getting bigger and bigger, then the percentage returns would also be getting bigger and bigger. They could. They definitely could be. So yes, returns can be non-stationary. And that's most of what we're going to actually observe in the wild, right? It's hard to find a stationary time series is kind of what I'm getting at. Just because, well, it's a nice theoretical assumption of provided that a security follows this precise geometric Brownian motion or whatever model that we think will dictate it. And that's not always the case. So I'm going to pull some Microsoft prices. So because this is an example in something on Stationarity and whatnot, and this is an example that's posted on the internet, you can infer that it's going to work in this particular case, right? I'm pulling pricing data over one particular year, that year being 2014, for one particular company. So bear with me in that we don't know the conclusion. We'll pull this pricing data. We'll check for stationarity. It's a price series, right? It's not going to be stationary. It goes up and to the right, which in most cases would be good. In the case of checking for stationarity, not so much, because it means we have a trend. Let's take these additive returns. In this particular case, we have that this additive series is likely stationary, and it looks like white noise. We'll also check the percentage returns right here, and those are also likely stationary. So we're not going to stress about it overall. In both instances, we have some stationarity in the returns over this particular year, so we'll roll from there. Now, whenever we have any sort of integrated order 1 time series, which theoretically prices should be, we can do this sort of setup. And that's where Cointegration comes in the first place. So this, again, is over one particular year. There's no guarantee that Microsoft returns are going to continue to be stationary in a year afterwards, possibly in years before. We can go and check that since we have past data, but none of us can actually see the future, so we won't stress about the future. So the definition of Cointegration specifically, and why we care about it, is that if you have some set of integrated of order 1 time series, if you can create a linear combination of those integrated of order 1 time series, such that the linear combination is stationary, that set is co-integrated. So basically what I'm saying is I have a bunch of price series. If I can add them and subtract them and multiply them by some constant value and pop them all together, I can get something stationary out of the end of it. I'm explaining the non-stationarity of some time series with the non-stationarity of some other time series. And this is a very difficult relationship to kind of explain. It's a very difficult relationship to find, right? It's hard enough to find one time series that's stationary, one return time series that's stationary, unless you pick a particular year. So it's going to be significantly harder to find some set, or in our specific case, a pair of integrated of order 1 time series that is stationary together, right? Because that's a weird, subtle sort of relationship. And unless there's a reasonable reason for why the non-stationarity of one, why the randomness inherent in one time series would explain the randomness of another time series, well then we have no reason to believe that it's going to continue to be so, right? So we want to start with some reasonable economic basis. We want some reason for why we would explore a particular pair or explore a particular set of price series. Maybe this is based on a joint relationship on some element. They're in the same sector. One company is eyeing a competitor of the other for a merger. Whatever. As long as there's a reasonable basis for us to be testing and trying to find this relationship, we can kind of narrow the search space in hopes that we can actually find a legitimate co-integrated relationship. So, in our particular case, I said we're going to be dealing with just a pair of things. So, all that we want is that we can take one price series and some other price series and buy one or two or however so many of one or the other and buy some and short the other. And this should create a stationary spread. And let's say this is an example where we have y equals 2x, right? Or y equals some alpha plus 2x. Or we can buy one instance of something and short 2 instances of something else. What we're essentially doing is we're taking out a hedge, right? We buy 1 unit of y, we short 2 units of x. We're hedging the nonsense of y with the nonsense of x and getting a stationary time series out of it. And whenever we're doing any sort of algorithmic trading, everything kind of comes down to making a bet. And in the case where we have a stationary time series, well, then that means we can calculate the mean and the standard deviation, provided that it's normal in this particular case, right? We'll just roll with a normal distribution. But if we have the mean and standard deviation of that normal distribution, then based on what the current value of that time series, of that spread is, we can make a bet as to whether it's going to revert or not to the mean. Now, in this particular case, we don't have like a time model of when something will revert. We just know, well, we just have a notion of whether something is stationary or not. So whether something is drawn from the same probability distribution or not. So we'd just be making bets and ideally include in our logic some notion of whether we've reverted or not. There are other sorts of metrics that you can use, like the Hurst exponent, or like if we were to fit like an Ornstein-Uhlenbeck process or some specific model that models mean reversion, that would give us a sort of time notion of when something is going to revert. In this particular case, this is not built in. So let's make some simulated data before we come up with another example from the stock market over a particular set of years that has co-integration. So I'll generate x1 and x2. And I'll say, hey, I have x1. It's some samples from a random normal. And x2 is that plus a little bit of noise.
Can you suggest like what frequency do you use when you trade co-integration?
It depends on the relationship. Sometimes a daily basis makes sense. It depends on over what time range a time series is stationary, right? If something is only stationary over years and years and years and years, then it would probably be unreasonable to look at it over minutes.
Right.
That's more of a judgment sort of thing.
So something can be non-stationary in one time scale and stationary in another.
Yep. This is something called like asymptotic stationarity. The more samples that you have, you approach stationarity. And you see this with a lot of annoying time series models. Yeah, so we have x1. We generate something that's integrated over 0, something that's stationary. We'll cumulatively sum it to get our price series. And then we'll add some noise. And that's going to be x2. And that's right here. In this particular case, obviously they're going to move together, right? Just because, well, one's the other plus some noise, right? In this case, if we want to calculate this spread, this z is this x2 guy, just to kind of prove to us that the other is also integrated of order 1, the additive differences of x2 are stationary. So they're both integrated of order 1, and we'll say, hey, we have this new time series that is a spread between them, x2 minus x1. So this is our linear combination, right? I buy 1 unit of x2, and I short 1 unit of x1. Sweet, simple. And we get stationarity, and it looks like white noise. It's great. If we're actually dealing with pricing data, you're never going to have something this nice. You're never going to have one instance of one minus one instance of the other. That is way too sweet and elegant to actually happen. And financial data is really just disgusting. So there's no reason we should ever expect that in the first place, right? So we need some way in order to actually estimate this. And I may have given that away. But the basic way that we're going to deal with this is with a linear regression, right? I'm going to say that I can express the returns of one with the returns of the other with some difference in between them. This makes sense. This is the same way that you would compute any sort of simple, naive hedge, right? If you're dealing with any sort of exposure to the market, it takes this exact same form. I have the returns of my portfolio, and they're equal to some intercept term plus beta times the returns of the market. And this beta would tell me how much of my returns, how much of my strategy is made up of the returns of the market, with some extra noise. If I have a high beta value, in this particular case, where I have a portfolio and the market, then that means that my portfolio is very exposed to the market. And it's probably not particularly novel or interesting. What I want in that case is to have a high alpha value, a high unexplained return relative to the market itself. In this case, I'm not super interested in that. In this case, I just want to know what beta is in the first place, right? Because what I'm saying is, OK, well, x2 is some extra stuff, some deterministic thing plus some noise, and also this other stack, ideally in this pair. So if I found some co-integrated pair, I want to know what that beta is so that I can know what to long and what to short. This is where I'm going to get that 1x2 minus 1x1. I'm going to instead buy 1x2 and short beta x1. That's my goal here. So in this case, I have a pair of securities over a particular year, and I have their prices. In this particular instance, this is a pair of alternative energy securities. And if you've gone through any of our other lectures, this is a pair that we discover in the pairs trading lecture. which is a pretty neat one. But the basic hypothesis here is that, okay, well, it's two securities in the same sector. They're going to have some relationship to each other, right? It may not be a strong relationship, but it provides a good basis to jump off for, to try to find a co-integrated relationship, to see if there's actually something meaningful out of there. So I'm going to take my pricing data for ABGB and FSLR, and I'll plot them right here. And again, it doesn't look nice, right? If I was just looking at prices, looking at price series, not that I should ever really be looking at price series without statistics firmly in hand, I would have no idea, or I would have no notion of any sort of relationship between them, right? Especially with this big ugly gap here. That's a little sketchy, but I'm not even sure what's going on here, right? They're just kind of going all over the place. It's just two prices. I pulled them at random, essentially. So if I compose this linear regression here, I see that, okay, well, I have a 1.5 beta here with ABGB. So if I'm going to compose this linear regression, what I'm going to do is I'm going to buy one instance of FSLR, and I'm going to short one instance of ABGB. And I might have gotten those two backwards, but it's a without loss of generality sort of thing there. So we'll plot this spread here. We test it. We get that it's stationary according to our hypothesis test, which is nice. We've got a weird, ugly jump here, but the hypothesis says that it's stationary. It's hard enough to find a reasonable signal in the first place. This is all part of like my research step, right? I found some potential pair. My test says I can get stationarity out of it, sure. Further down the pipeline, I may cull this and get rid of it, right? It's totally possible, right? Because this is just, again, over one particular instance of time, over 2014 to 2015. It is not necessarily so that this is going to remain stationary, this particular spread, especially with 1.5 units, right? That's one particular spread calculated over one particular set of time. So another sort of thing that might give us pause, right, is, well, this is over 2014, 2015. I built my linear regression over 2014 to 2015. So this beta value is based on all of this time. It's not based on what I would have known at this point in time, or what I would have known at this point in time, right? That beta is going to be different. So if I actually wanted to sort of trade this or deal with it, I would need some sort of constantly updating value so that I have a meaningful notion of the relationship here. So it's not just x2 minus 1.5 x1, because I don't know about that. It's probably going to be significantly higher here, or it's going to be something else. So that's going to change over time. This is an instance of, well, look-ahead bias, right? In this particular case. We're not going to stress about it. I'm just kind of calling it out so that nobody else calls me out about it later. So we have this stationarity between these guys, right? That's great, fun, fantastic. Again, it's only a forecast, right? I don't have any sort of notion of timescale over when it's going to revert. And this is just one pair, again. If I'm dealing with multiple pairs, well, if I'm dealing with pairs strategies in general, or what I want to be doing is making as many different independent bets as possible. This is one bet on one spread, one constructed asset. That's a terrible idea. If I want to actually be trading pairs, I want to be trading as many as I possibly can. I want to be trading 100, 200, 300 pairs, as many different independent bets as I can make, right? If I told you that you had a 51% edge in blackjack, and here's $10,000 to go play with, you're not going to place that, or at least you shouldn't place that on one single table. You are going to take the smallest unit bet that you can make, and you're going to bet at that many individual tables. Because, well, the more bets you make, especially if they're independent, like 51% chance independent every single time, that's how you're going to get that 1% edge, not from placing it all on black, which is still going to be a 50-50 sort of setup. But don't worry about it. I'm mixing my metaphors. It's fine. We won't stress about it. But in the same sort of case, right? We have some notion of how this spread is constructed. We have a stationary probability distribution. It's normal. I can make bets based on how far away from the mean I am, And I want to make as many different bets of those as possible. Yes?
Just to double check, so that last run that you did, that was on price series, not returns, right?
That was on price series. It should be on return series.
It should be on returns.
It should be on
You did on
returns.
return, right? In regression, you did return.
I did prices.
You did prices.
Yeah.
You did prices. So then, because my next follow-up was with CAPM, right? You
Yeah.
said it yourself.
You do it with returns.
You do it returns.
Yes.
So what was the rationale?
The rationale is that this is a basic and, in many cases, flawed example. This should be on returns. If I was going to actually go and diagnose that regression, that would probably be the first thing that I'd look at and then change and update in the lecture, which is on my list.
Got it.
Yes. So the kind of classical way that we handle calculating a pair, dealing stuff with that, is actually on the log returns. So you do this sort of exact same layout as I've done, where I have some pair. I take the returns, I take the log of those returns, and I calculate the linear regression between the log of those returns. It's called the Engel-Granger method, in case any of you guys want to look it up. Similarly, the Cointegration test that I link down at the bottom is also based on this same exact sort of notion. I take this linear regression, I check whether the linear regression is stationary or not, and go from there. And that tells me whether it's cointegrated. Because what I did was kind of like an annoying setup, right? I take my prices, I do a linear regression, and then I check whether that difference there is stationary. This already does that for me with some other built-in things in the documentation that I don't remember off the top of my head. But that's all there for better reading on that specific method and how it would work. But this is just a super simple way that you can build a basic quant strategy, right? It's based on an incredibly simple assumption when we deal with time series, based on this idea of stationarity, and we can build up from there. Because as long as you have some reasonable thing, some reasonable model of how the world is, then you can make a bet on it, right? All you need is some modicum of information more than someone else. All you need is that 1% edge in order to make a relatively reasonable bet, as long as you make as many different bets in that same way as you can. So that's just kind of the background, what makes a pairs trade go. A background of some super basic statistical arbitrage. And that's really all that I have here today, right? Statistical arbitrage, it can be as simple or as complex as possible. In this particular instance, I made a bad linear regression between some canned examples and really didn't do anything else, right? I incorporate some look-ahead bias and boom, example. If I wanted to do this in a smarter way, right? I'd be calculating rolling linear regressions, first of all on the returns, but I'd be calculating rolling linear regressions between them so that I have a constantly updating notion of what this spread is. On top of that, well,
I mean, here you
Yeah.
can still assume you are doing for that point.
yeah, it's all based on that point, right?
You're deciding on this January 2015.
Yes. So let's say that I am great and I've prepared adequately. We're looking for the 2015 year. This is what my calculated spread is. But if I want to kind of actively trade and update it, this is still built over an entire year, right? I'd want to roll that window forward day by day. And well, how would I actually trade on this, right? I've said a little bit that it's mean reverting. So what I essentially mean is that we're going to oscillate back towards this center. So we're going to make bets whenever we're particularly low or particularly high. But in that same vein, this mean, the mean that I know about at this point in time, is different from the mean that I know about in this point in time. So even beyond this rolling spread that I need, this rolling notion of the spread, I need a rolling notion of the mean and of the standard deviation. Because, well, let's say that I want to make bets when I'm one standard deviation from the mean on either side. I want to make bets when I'm particularly low, and I'll go long this spread, and I want to make bets when I'm particularly high, and I'll go short this spread. I need a meaningful notion of what that standard deviation is, right? So those also have to be constantly updating if you're actively going to bring this in. So that can be done with moving averages. That can be done with more sophisticated models with Hornstein-Uhlenbeck. That can be done with Kalman filters, if you like Kalman filters, which are the rich man's moving average, or I like to call the moving average the poor man's Kalman filter, and we see how that kind of goes back and forth. But there's a million different ways that you can iterate and improve on this, right? And this is why this is such a prevalent strategy in general whenever we're dealing with quant stuff. It's a unit strategy. We can add as much complexity as we want, or we can keep it simple and just deal with moving averages and nothing particularly special. So, I don't know. Stuff really gets about, you can be about as creative as you want whenever you're dealing with quant strategies, as long as you have a reasonable idea of whether you have more information than someone else, right? Because this stationarity, this co-integration between some pair of stocks, if you know about it, it's a subtle relationship. It's sneaky. People spend a lot of time researching pairs. People spend a lot of time trying to suss this sort of thing out. And ideally, if that pair still exists, if that relationship still exists, then you can trade it. And hopefully not too many other people are trading it, otherwise that gap's going to close. So you want to be constantly researching and constantly coming up with more to fill out your portfolio of 100 pairs, 200 pairs, 300 pairs. And ideally, once individual pairs break and go out of co-integration, you'll still have this overall portfolio that is nice and co-integrated and wonderful. So that's my talk. Thank you. Questions?
Is there a notion of risk in a given pairs trade, and similarly, is there a notion of reducing risk in a systematic way in a portfolio of pair trades? So, like, you know, for example, in Marco's portfolio, you have covariance, and you're basically trying to minimize the idiosyncratic risk. Is that done, or is there a framework for that, or? Because you'd have to have like a notion, an idea of how risky one given pair trade is, right?
Yeah. So as I just described it, a portfolio of pairs is a portfolio of independent bets. So kind of going from there, based on that, I'd probably assess the covariance in the first place, but I would be operating under the assumption that they're independent from each other. Especially because kind of the nature of how a pairs trade is constructed, you get rid of the market just because you're hedging one thing against another, and they probably have similarly proportional ratios of the market, and we get that out of the picture. So you're just trading this constructed asset that's kind of independent from other things. And especially if this relationship is just based on the pairs involved, which is what it should be, then that relationship should be independent from any other pair relationship. So I wouldn't be stressing too hard about it.
So you just want as many bets as possible?
As many bets as possible. Yeah, ideally they should be independent. They're probably going to be, but that's definitely something worth checking. You'd probably check the covariance or the L2 risk or whatever risk metrics that tickle your fancy, right? Whatever you think is a meaningful notion of volatility for a given pair or for a given set of pairs, that's something to look at when you do the construction. What I'm essentially proposing is I have 200 pairs, right? I said nothing about how I want to allocate amongst those 200 pairs. Right. I could allocate amongst them based on some sort of Markowitz, mean variance portfolio. I could minimize L2 risk instead. I could minimize whatever if I felt like minimizing, or I could just equal weight and not deal with it.
Cool. In practice, how often do they rebalance? As you said, the mean is changing. Like how often in practice? How often do they rebalance this?
It depends on the pair. Daily is reasonable.
Daily?
It's reasonable, depending on what time scale of data you're looking at.
Your market zero, basically. At all times, you don't want to have any exposure to market.
Yeah. Yeah, it really depends on the individual pair. Like if something is mean reverting or stationary over a very long period of time, you're going to be making very infrequent bets, right? But if you can find stationarity over like a monthly scale, I'd step down and try to trade it daily. Similarly, if I found stationarity over years and years and years, I would try to trade it monthly or yearly instead. Again, it's super variable.
General question. The data that your company provides, where are they sourced from?
I don't know off the top of my head, but let's take a little journey over to the data page, because it's all there. So I know our fundamentals data is from Morningstar, and There's a bunch of other possible data sets that you can trade with that come from various different sources.
And can the developers use real-time, like a millisecond or intra-minute data for day trading purpose?
The most granular data that we have is minutely.
Minutes?
Yeah, we don't have the tick level or intra-minute at all. Mostly what we're interested in is algorithmic trading, not necessarily high-frequency stuff.
Are those minute data delayed or they're real-time?
It's real-time. Yeah, if you're live trading an algo, if you're dealing, or if you're simulating a back test, it's simulated as if it was real-time. Yeah, check out this page if you want to see the other stuff that's available and who else might be providing data.
Are you guys based in Bay Area or where are you guys from?
We're out of Boston,
Boston.
actually, yeah.
So office here down here? Or?
No, I'm just here for the weekend. I was in Seattle last week giving a couple talks, running a workshop, and now I'm here, giving a talk tomorrow in SF.
You mentioned that it's better to use returns rather than prices. Could you explain a little more about what you were talking about there?
Well, I mentioned before that we have a bunch of assumptions that go into AR and MA models. Similarly, we have a bunch of assumptions that go into linear regressions. And if you're just doing a linear regression of one price versus another, you're probably violating a good chunk of them. I would suspect that there's going to be some heteroscedasticity or something like that in that regression specifically, which would be like a trend in the variance, which blows everything out of the water and makes it non-viable.
Has any of your strategies been in production, been triggered?
Mine or?
Just the one that mentioned in the past then.
I don't think I can say anything about the actual strategies that we've allocated to.
Have you used correlation or covariance between time series to kind of gauge the relationships?
For pairs? I know that that's a common thing.
What's the question? I'm sorry.
The question was whether you can use correlation or covariance between pairs to model the relationship instead of co-integration. I dislike it just because, I don't know, correlation is just kind of a measure of whether things go in the same direction or not, more often than not. Whereas in the particular case of co-integration, that says something more meaningful, namely stationarity. Like I find that to be a stronger condition. And since I tend to be fairly conservative whenever I'm looking at ideas and trying to decide whether an idea is good or not, I'm going to err on the side of looking at the stronger condition than looking at the weaker condition.
In terms of co-integration, it's much better than covariance method. And the reason for that is you want to, as you said, you want to diversify among multiple of these pairs. And if you do it with co-integration, you will have statistical performance of it, like in terms of volatility of it, the mean of it, so you can actually make your sizes, bet sizes better this way with that rather than the other way.
Yeah, that's another very good point, right? So if you're doing correlations, right, how do you deal with the bet sizes? If you have like the mean and standard deviation of this hypothesized spread, then you can use that to meaningfully bet and construct your sizes. Whereas with the correlation, I don't really see how that could be done in the same sort of systematic way.
I was just going to say, I know it's probably unlikely that you come across this, but mathematically you can certainly have a co-integrated relationship with a zero correlation.
Oh yeah.
So it's like mathematically it doesn't say a thing. In practice, I'm sure there's some validity there.
Yeah, the reasonable pairs are going to have both, basically. Because you can have a pathological example of one without the other, and then one without the other.
Exactly, that's the other point. You don't have, like, in terms of R square, how much meaningful that correlation is. You might have correlation, but you don't know how much meaningful that is.
Totally reasonable.
But in co-integration, you will get
something more reasonable. We have some pathological examples of both in some of our other lectures, namely an example of co-integration without correlation is a square wave and something stationary. Because that's just silly. There's going to be no correlation whatsoever, but it's co-integrated. Cool. Any other questions? I'm going to hang out for a little while, so if you don't ask me a question now, feel free to ask me a question later. All right, thank you so much.
Thank you.